Hi, I'm Gene Trowbridge, securities attorney with the law firm of Trowbridge and we do syndication legal work, primarily in Regulation D, Rule 506B or 506C, in all sorts of asset classes, real estate. We did a hockey team last year. Anything where you need to raise money from a group of investors and you need to comply with the securities laws, that's what we do. And you found us and our YouTube presentation on 1031 exchanges. So if that's what you're looking for, you're in the right place. So I'm the founding partner. I was a syndicator for 20 years, been a real estate broker, it seems like all my life. CCIM instructor for over 40 years. But when I was 45, I went to law school and I've been a securities attorney ever since. I wrote a book, It's a Whole New Business. And in this presentation, you'll get an opportunity to get a free PDF copy of the text of the book. In my spare time, some of you who know me, I'm an old half marathon runner. What we're going to cover here is the rules on the Internal Revenue Code, Section 1031 for individual investors and how that relates to LLCs. And then we'll talk about the 1031 rule for LLCs and what you have to do to make this all happen to accommodate your investor who wants to defer gain by using the rule 1031. So the Internal Revenue Code, Section 1031, this is the language, and I've highlighted the important parts. It says no gain shall be recognized when a trade or business property is exchanged for a trade or business property. So basically what that says is, here's an example. You have an apartment building that you've owned. You want to exchange it for another apartment building. Okay, so that's a trade or business property being exchanged for another trade or business property. And if you do it right, no gain or loss, so this is obviously a tax code, no gain or loss will be recognized. Now, it doesn't have to be apartment building for apartment building. It could be an apartment building for an office building or for a self-storage. It actually could be an apartment building for an office building you're going to control, to live in, to operate your business out of. It could be a apartment building for a hockey team. Anything that's a trade or business property, something that's you use in your business and or rent out. Now, it has to be real property for real property. You can't exchange an apartment building for a backhoe. It has to be like kind. So that's the rule, and that's what's happening. People are coming to us now where they purchased properties 5 or 6 years ago, and they have created quite a bit of equity, quite a bit of increased value. And so if they were to sell, they'd have a gain to report. But if they can use this code section, no gain would be reported at that time. It's deferred until the future. And why is this important to investors? Well, when you sell the old property, you have equity. You paid something for it. Now you're selling it and you have all this equity. And you want to use that equity to go over and buy a bigger property, okay, with a bigger purchase price. You want to take your equity, but what you don't want is you don't want your equity depleted by the gain that you have to report on a taxable sale. So when you when you buy a property, you have a purchase price, which is your basis. As you take cost recovery, your basis goes down. That creates a gain. And as the property goes up in value, you create more gain. So on a sale, the total of the gain from appreciation, capital gain, and the total of the gain created by having taken cost recovery gets to be taxed. Well, if you do it right in an exchange, you can take those two gains and move them over into the new property And how the government keeps track of those gains is here you have the purchase price of the new property, which would normally be your basis. But the government says, no, let's reduce your basis to something called a substitute basis by reducing the amount of the purchase price by the gain deferred and by the cost recovery deferred until you get to a new substitute basis. And why is that important? Well, let's say the third transaction is selling this property, and at that time, you're going to pay the tax on the gain and the cost recovery from the very first property. Well, you could exchange properties over and over and over, and that's one of the issues with doing exchanges. You end up having so much gain that you've deferred from the past that a sale is really impractical. So in that case, you do some estate planning, and figure out what's going to happen, because at the end, I mean, if you die, then all that stuff goes away. So it's going to take some planning if you're a habitual exchanger. But what we're talking about right now is some investor going to sell their property and they have all this gain, and they'd like to defer the gain into an investment in your LLC or an LLC. That won't work. And why that won't work is the fact that an interest in an LLC is a partnership interest. You don't acquire title to a property, and we're going to find that that's the problem. So when my sponsors come to me and we want to start drafting the documents for a deal, the first thing I ask, or one of the first things, is, will any of your investors that you know of today require 1031 tax deferral? And if the sponsor says, no, I don't know of anyone, then we're just going to go right in and take title to the new property in an LLC. All the investors will invest in the LLC, and that's fine. But if there is someone who wants to do tax deferral through 1031, then we're going to have to use a tenant in common structure in our deal. And the reason is back to the 1031 rule and these words, like kind. A deed in real estate is not the same as an interest in an LLC or a limited partnership, because the IRS defines partnership interests as not like kind. In fact, there is an exception to the 1031 rule that says partnership interests do not qualify for 1031 exchanges at the investor level. That's important. The investor has a deed to a property, that's fine. But when they exchange, they have to acquire a deed to a property. And they're not doing that when they come into an LLC. And the same thing, if they're in an LLC now, let's say they have 20% of an LLC and they want to go out and buy their own property and get their own real estate deed, that won't qualify either, because the partnership interest is not like kind compared to the deed. And so we put it in our offering documents. Actually, it's in there 3 times. And what we say is this is not suitable for 1031 exchange. The interests being offered here are considered for IRS purposes to be personal property as partnership interests, and are thus not suitable for a 1031 exchange. Investors seeking to do a 1031 exchange should not invest in this offering. And okay, so this is dealing with the investors and the investors level. We're going to see how it's a little different when we're talking about the LLC exchanging its deed for another deed, and the LLC goes forward and owns a new property. We'll see how that works. So the entity that has the deed to the property does qualify for a 1031 exchange at the entity level. So let's say I own a piece of property in an LLC. The deed is to the LLC. I can exchange for another deed, and take title through that LLC, and I'm going to do a qualifying a 1031 exchange. But now my sponsor's entity that maybe has 30 or 40 investors in it, that entity has a deed. That entity can take their deed and exchange for a deed in another property. And the entity qualifies for the tax deferral in a 1031 exchange. So that's good. So there's a different rule for the individual than there is for the entity based on going a deed to real estate to a deed to real estate. So when are we going to ask this question? Well, as I said, we're going to ask this question at the beginning of time. And here comes our acquisition. And we find that we have an investor who wants tax deferral. So they need to take title to real estate. So the LLC is going to take title to some of the real estate, and the investor is going to take title to some of the real estate. But the way to take title is to have a deed. And the only way you can get a deed and not be a partnership is a tenant in common interest. And the IRS has rules on that. In this revenue procedure that I list there, they list all the rules. We're going to discuss some of them in a second. So here's our typical structure going into a deal. If you know you have an investor or you're the investor and you want to do tax deferral, you will take a percentage interest in the deed. We call it a fractional deed as a tenant in common. So that's your property, totally yours. And the LLC who's raising the rest of the money will also take a fractional deed as a tenant in common in the property. So we have one property, and we basically have a deed that's divided into two parts. The LLC has a deed that's all theirs, and the tenant in common has a deed that's all theirs. And it has to remain separate, because the revenue procedure says if you put these two together and to make it look like a partnership, it won't qualify for an exchange. And through operations, the cash flow, the refinancing proceeds, sales proceeds are split on a pro rata basis. Let's just say both of the tenants in common are 50% owners. At the end of the year, the cash flow that's to be distributed, 50% goes to one, a tenant in common, and 50% goes to the other. Refinancing proceeds transferred on a pro rata basis. Sales proceeds transferred on a pro rata basis. What my sponsors need to know is that the TIC that is the LLC has no relationship to the money coming to the TIC that's owned by the individual investors. There can't be any preferred return, and that the concern there would be from the TIC investor, the individual investor. Can you apply a preferred return to them? No, they get their share. No matter what their percentage is, their share is given to them on a pro rata basis. There's no manager, there's no fees, there's no sharing of cash flows to the individual TIC. Decisions must be unanimous. The investor has a deed, totally their deed. No decisions can be made that affect that deed unless the investor with the deed agrees. You can't decide to sell the property, refinance the property, actually even lease a major portion of the property unless both deeds agree. Now, there's a provision in the tenant in common agreement that says if both parties don't agree, we have a shotgun. It's called a shotgun provision, where in 30 days, the investors, the two TICs, have to get together and decide if one person's going to buy out the other person, and then they can go forward. But if no one wants to buy each other out, then the decisions can't be made unless they're unanimous. And the most confusing thing is in the revenue procedure, it says, you better write a letter to the IRS first and say, this is how I'm going to put this deal together. Will this qualify as a good 1031 exchange and not be treated by the IRS as a partnership. Well, no one is going to do, and no one does in practical experience, ask for a private letter ruling. By the time you send in a private letter ruling request and the IRS gets to it and all the rules that go along with asking for a private letter ruling, 6 or 7 months have gone by and you can't get an escrow that long to buy the property. So in practical experience, everyone drafts the tenant in common agreement just the way the revenue procedure says they should draft it. And there's 16 provisions in the revenue procedure that I follow when I draft the tenant in common agreement. But I do put in the offering document, generally in the PPM, this clause here that, we haven't applied for a private letter ruling. We should. We haven't. And there's a possibility that if this transaction is audited, the IRS will come along and disallow the transaction for 1031 purposes. What does that mean? That means the individual who wanted to defer gain by taking a tenant in common interest, that might get rejected, and they may have to pay taxes. And if it's rejected, they no longer have a tenant in common interest for the purpose of this rule. And in the future, they cannot do an exchange going out because the IRS will look at the tenant in common interest as really part of a partnership. And remember, partnerships don't qualify for 1031 exchanges. A lot of stuff going on in this rule. There's no doubt about it. And in my book, and you're all going to get a copy, or you will get a copy of the PDF of my book if you go to this website, book.tnllp.com. And at that website, you'll get a free PDF. And in the book is a chapter on entity structures. And we'll go through a lot of the information about a TIC and about 1031s and the revenue procedure in detail. And you can do some research and you can read about it. So once again, this was Gene Trowbridge. Thanks for being with me on our YouTube channel. We have a lot of YouTube, so come back and join us. Actually, subscribe to our YouTube channel. If you have any questions, you can just call us at the office and schedule an appointment with myself or Jonathan or Tim, the 3 attorneys in the office, and we'll be glad to talk to you. Thanks very much.